Hey traders, Jason here from Leavitt Brothers. So in this video, I'm going to talk about how we are running out of places to hide on the long side. Okay, I've been saying since January that we're in a bear market. Maybe the indexes weren't down 20%, which is the definition of a bear market, but the character and personality of what was taking place beneath the surface told us that we were in a bear market. But even though we were in a bear market, there were places to hide. There were stocks and groups that were doing well, and we could play them to the long side even though most of the market was trending lower. But those places are now no longer offering a great place to hide. So I'm going to go back over the last year and just go step by step how things have progressed and how they've led up to today. Okay, so going back at first, this is well over a year ago, first the stay-at-home stocks topped and fell. Stocks like Peloton, Zoom, Tupperware. Let's just go through those really fast. So you can see here's Peloton. This is a 15-month chart, so it topped more, well over a year ago and is down, has lost a big chunk of its value. Here's Zoom, also down 80-90%. That it topped out more than a year ago. Here's Tupperware, another one of those stocks that benefited from people staying at home because they wanted to beef up their home office. It topped well over a year ago, and you can see today that it's down a lot at a new 52-week low. Okay, so then first the stay-at-home stocks topped and fell. Then a lot of tech headed south. Okay, so there are currently hundreds of high-quality names down more than 50%. So let's go through a couple of those. So here's PayPal. As you can see, while Peloton and Zoom were trending down, some tech just started to form topping patterns, as you can see, and then starting in October, November, it headed south. Here's Square, same thing, big topping pattern. It did not continue to move up. It topped, and then in October, November, it also started heading south and is now down more than 50%. Here's Net, one of the higher quality names. It went vertical in October, November, but it quickly gave everything back and is now more than 50% off its high. Okay? All right, so again, first there were stay-at-home stocks topped and fell, then a lot of tech stocks headed south. But while that was taking place, there was a bull market in commodity stocks: oil, uranium, aluminum, ag inputs, food, coal, gold, and silver. Okay, these stocks, these groups gave us a place to play. So even though tech was in the dumps and trending down and there was no way to trade them on the long side, there were plenty of groups that gave us plenty of stocks to trade. Okay, we had a bull market in commodity stocks, we had a bear market in everything else, and so if you didn't want to go short, you can very easily go long some of these commodity names. In fact, it was better to go long the commodity names because while the tech was going down 40-50%, some of these commodity names were going up 100, 200, 300%. So there's actually more money to be made playing the commodities to the long side than there was playing tech to the short side. But now, many of those commodity names are falling. Okay, so here's a bunch I've listed here: AA, CENX from the aluminum space. We got a couple of uranium names, some ag input names, a food stock, gold and silver, industrial metals, and steel. So I'm going to go through these one by one relatively quickly. All right, so here's Alcoa. Obviously, really nice trend up. Looked like it was doing great, finding support at its 50-day moving average several times, and just in the last 2 weeks it is completely broken down and is no longer trending up. So it is no longer one of those safe haven stocks that you can buy in a dip and just hold. CENX, same exact thing. Okay, formed a really nice base here, broke out, went vertical, had some good volume, was basing again with some kind of sloppy-ish movement here. Okay, but it is completely broken down, so it is no longer a strong stock in an uptrend, so it's not a place to hide there. UEC, uranium play, nice bull pattern, consolidating over here, broke out, strong volume over here, has completely lost it and is back within its range. No longer a place to safely hide out. NEX, not quite as good, but they had potential. It had a bottoming pattern here, consolidate here, broke out over here. You can see strong volume over here, was looking good. Obviously, there were highs over here that needed to be dealt with. But if it could hold these gains here, it was well positioned to break out and make a run. Instead, it fell, so no longer a place to hide. FMC, an ag input name, steadily trended up. So, got rejected by the 50 there, flirted with the 50, but then once it started up, it's like 50, 50, 50, steady trend up, 21, 21, 21, and it has completely lost it. A great stock that provided us solid gains in a pretty safe group that was trending up because of inflation. That trade is over. No longer a place to play. IPI, similar group. Okay, moved up. We had a base here, moved up, base there, and then it almost tripled. But that's over. Look at how big the move is down. Okay, if it was a strong stock, it would have just consolidated up here and then eventually broken out. But the chart is now broken. Anderson's, steady mover, slow mover, safe place to play. That's what it was. It was just a safe place to play. If tech scared you and you didn't want to play high vol, you didn't like the volatility, here was a stock that just moved like point by point. You could buy dips, hold on, but that trade is over. You can see today it's down over 30%. Next up, silver. Here's AG. This one was forming a pretty nice base here. You can see this. Okay. Boom. Consolidate here. Was looking like it was positioned to break out and run. That's over. Completely smashed. Chart is broken. No longer looks good at all. Here's Newmont Mining. Really nice basing pattern here. Runs up. If it could have consolidated here, it would have been nicely positioned to make a run at 100, but instead this chart's broken, gapped down several times, sold off hard, and is now consolidating below its 50-day moving average. VALE, steady trender, 21, 21, 21. Okay, higher highs, higher lows, month after month, doing really well. Now the stock is completely broken, no longer a place to hide. X from the steel space, messy bottom here, but that's okay. Broke out, did fairly well. It's consolidating again here. Chart is now broken. Last one, CLF, really messy bottom down here, but as you can see, it eventually resolved up. Strong volume over here, did great. Okay, not really playable because of all these overlapping candles. I would never be interested in a stock like this that had so many overlapping candles and like these long tails. But it's still an indication of what's going on in the group, and it was doing well, but that's not happening anymore. Okay. So now I'm down at the bottom of the slide. So there are many less places to hide. January to March were terrible for tech, but we could still play commodity names for solid moves. But many of those names are no longer trending up. So that's the situation right now. First, you had the stay-at-home stocks topped and fell. Then most tech names topped and started to trend down. Most are down more than 50% now. But while tech was in the dumps, we had a bull market in commodity stocks, lots of plays there. But now the commodity stocks are kind of off the table because they too have broken down. So I can sum it up and just say, like, the market is getting less discriminate, meaning when it drops, almost everything gets pulled down. Okay, there are no safe havens. There's no place to hide. Everything gets pulled down. And what this means is this is a sign that funds and traders are just selling anything to cover losses. They're not differentiating between good and bad. They're just selling anything they could possibly sell. So what I'm wondering is, is there a downside air pocket that once crossed will induce a crash? Okay, it's worth considering because other than currently being stretched to the downside from a sentiment standpoint, there's nothing to be optimistic about out there. Okay, Not predicting a crash, although I do think we're going to have a hard move down at some point in time. It's just the timing of that is the hard place. I just wanted to bring to your attention what has happened over the last year as money has started to come out of the low quality names, then the higher quality names, then the commodity names, and we're at a point where money is just indiscriminately coming out of everything, and that is not a good sign. The market is extremely weak below the surface, and even if the Fed says something nice today and the market has a relief rally, the rally is probably going to get sold. We're going to go back to the lows, and we're going to take out those lows eventually and go much lower. All right, hope you got something out of this. We'll see you next time.